Thank you everyone for joining us. This is our Ripple Ventures Tank Talk on the outlook of venture as a top tier VC with partner at Menlo Ventures, Houman Haghighi. Why don't we go into a quick background on who Houman is before we get into the questions that everyone has submitted. Thank you so much for joining us, everyone. So everybody, I'd like to introduce Houman. He is a partner in charge of business development and strategic partnerships at Menlo Ventures, been there for almost 2 years. Previously, he was at Qualcomm Ventures for about 7 years, where he was director and head of business development. During that time, he was also the head of the Qualcomm Robotics Accelerator, part of Techstars. And prior to that, he was a senior program manager at Qualcomm Corporate with Qualcomm IT and a product manager and senior engineer. In terms of his personal background, he went to the UC San Diego School for Computational Cognitive Science with an emphasis in computer vision, and he's a founding investor and ERI board member of DARPA. Houman, thank you so much for joining us. Is there anything else you'd like to address in terms of your personal background, what your focus is on at Menlo today?
Well, thanks for the walk down memory lane. A lot of interesting stories from the trenches, but appreciate you having me here today and excited to share some thoughts about the way we're viewing the world, the new world order that we're in, and potentially where companies can continue to grow and prosper in this world.
Perfect. Well, let's hop into it then. So
Sure.
Obviously everyone wants to understand, what a top tier VC's outlook is on venture right now. First question is, how has the firm's strategy and diligence process changed in this current world?
That's a great question. So, overall, if you probably noticed, the lens for every VC firm has gotten sharper. Everyone's kind of looking at things with a fine-tooth comb, mainly because it's a nature of the world that we're in. The public markets have taken a significant beating, and there's been some interesting bear rallies recently. Private markets typically tend to track public markets and usually follow. There's a slight delay from private market standpoint. So we've seen actually, as the public markets have continued to kind of rally and increase, there's this sort of stipulation that this cannot be real. We're not going to have a V-shaped recovery. There's a really high chance that there's going to be either a U-shaped or a W-shaped recovery with another potential drop. And given that, people are a little bit more timid than they were before. That being said, the high quality VC firms, the high quality companies are getting funded, high quality VC firms are still investing. So from our perspective, it's a little harder. We'll probably get into this a little further in your questions. It's a little harder to get to know companies over Zoom. That human element, the time that we spend face-to-face building relationships, always is much harder. But if you think about history and the way that human psyche works, we've kind of evolved, and we've always used different tools. Previously, you met in person, a couple folks got in a room, old boys and gals club or whatever it was, and they made a decision on what to invest in. That world changed where people were a lot more collaborative and using email and using remote communication. And Zoom is just a natural progression of that, Zoom being one example. I'm a little biased since we're early stage investors in Zoom in my previous firm, and got a chance to kind of see the company grow. But if you think about the overall general landscape, a lot of great companies were created in a downturn. Companies like Airbnb. We were investors in Roku, actually. Roku was started in 2008. And Uber were Series B investors in Menlo, and that company was also started essentially in a downturn and continued to prosper and grow. So we see that there's a lot of history on companies that can grow out of a pain point that consumers have, the jobs to be done that consumers have, and great companies are created. So when recession happens, kind of answer another aspect of your question is, when a recession happens, tourism capital, which is sort of this like floating dollars that people are just kind of testing the waters with. They're not sure if they want to do CVC or they want to invest dollars. So they're like, let's just test the market and make a few strategic investments. Those tend to dry up. And what's left is sort of the top tier firms that are able to, that have a good track record and are able to actually keep working through a recession, making bets. Nature of the beast is that when a recession does happen, we end up having lower valuations. So companies are raising either flat rounds or down rounds. And that's a normal occurrence that happens. It's not something to be freaked out about, but it's about just, hey, making sure you got enough dollars. And again, we'll cover this further down, enough dollars to be able to make it through the downturn to come out stronger. From our standpoint, I think a downturn, lower valuations potentially, we haven't seen a lot of that, mainly because there's so much competition, is is that it's a buying opportunity. In the long term, we see a lot of opportunity for upside. So the whole concept of buy low, sell high makes funds like our Menlo 11, which was started in a downturn, did extremely well, mainly because valuations were a lot more palatable than they have been recently. There have been some very frothy valuations for companies, and puts us in an interesting place, in a good place as a VC firm, and creates a lot of opportunity for good companies to float to the top and succeed. One more data point to share with you from a just general landscape of top tier VC firms. The top 10 funds have raised at least $1.6 billion over the last 3 years. There's a lot of dry powder out there, a lot of cash trying to find a home. And if you have a great company, if you have a great vision and a great platform, which we'll talk about some of those KPIs to today's conversation, you will have a chance to raise great amounts of capital and do well.
Right. And if you have a 10-year fund and you haven't deployed that capital, you know, the clock is ticking and you still have a little bit longer term horizon, you're okay to make investments now to ride it out. Also, it sounds
Absolutely.
like a flight to VC quality happens in both public and private markets. So, you know, Menlo been around since the 76. You know, you've seen a lot of these sort of up and down cycles, and your investors have been along for the ride with you. So those endowments, they're still supporting you. They still want to be a part of this, and they see that you guys can probably ride the tide better than most given your history, right?
Absolutely. So I think the history track record showing that we've made it through previous downturns definitely is a feather in the cap. I mean, we take pride in that we've been able to navigate previous downturns, and history does tend to repeat itself in some ways, maybe in different form factor, and we feel we're positioned very well. When the downturn did happen, let's say March 19th or 20th, when sort of the floor fell and everyone kind of said, well, what's going on? Everyone freaking out. There's obviously a pandemic. People are working from home now. Let's say sort of social distancing, handshakes have gone away. The approach we took was, hey, let's get together as a group. Let's look at our entire portfolio. Let's figure out which companies need capital. And that capital can come in a variety of ways. It can be follow-on rounds of financing. It could be a down round. It could be a flat round. It could be an up round. It could be debt. I mean, the debt providers have been great. And in this case, there's actually sort of a new dynamic now, separate from debt or equity, is the PPP loans. I mean, I think a lot of folks have tapped into that. And sure, there's been some negatives and positives around that, but there's cash out there. It's just you got to hunt for it and figure out what the right angle is and strategy for getting the right cash to help you sort of get that additional month, 6 month, year, 2 years ideally down the line to be able to survive the sort of turbulent and turmoil times that we're in.
Gotcha. Thank you. So I guess, so now you're looking at companies, which metrics have proven to be the most resilient to the crisis across your portfolio?
Yeah, I mean, I think it varies from company to company. So it's the main thing we look for initially is capital efficient businesses. So you got to look at what are the KPIs that matter to your business. What is it based on, whether you're a consumer or enterprise or some kind of a life sciences or health company? What are the things that you're seeing that are elevating your business? So some companies have gotten a lift as a result of COVID. I sometimes joke that COVID is a digital transformation accelerant, and it's actually helped companies that were probably flat or slowly growing get sort of this additional boost of energy. There's sort of this notion that you got to think about what is it that you need to do to track in order to be able to make sure that you've got the sort of the upward momentum going. And for every company, it's a little different. So I'm not going to get into specific details. I'm happy to connect one-on-one and go through your concept and give you guidance on it. But I think the main thing is that if you've got that upward momentum on the right KPIs, and the ones that you don't have upward momentum on, either cut bait or potentially course correct or adjust. So if you can course correct and iterate on your plan on a regular basis to make sure that all the metrics are heading in the right direction, I think you're gonna have a great chance to make it through some of the challenging times.
And so in your portfolio today, were there some metrics that were obviously focused on maybe when the company was coming out strong with a lot of capital to deploy, now are considered maybe vanity metrics, and what were some of those that you could address?
I mean, it all comes down to customer mindset, right? So if you think about what is it that the customer wants, so let's say if you're a SaaS-based platform, then is your customer spending time on the right things on your site or your application for the right amount of time? And is the engagement there? So if you've got engagement, utilization's high, you've got sort of a stickiness. Your cost to be able to acquire customers is at the right level. You're not overspending in order to be able to acquire your customers. Those are probably some really interesting main ones that we care about. So customer traction and validation are the most, and sort of the most important factors to consider. Obviously, product market fit is a factor that we look for, but also the market is changing. So in the current market that we're in the current dynamics, the new human psyche that we're experiencing, do you have the right product for this market? And are you able to continue to deliver for your customers? You look at great companies like Cohesity or Zoom, and the reason that they've done extremely well is because they've been very customer-minded products, customer-minded founders. And even the motto of Zoom, which is around happy customers, didn't come out of nowhere. It's just the way that the entire company operates, from the CEO all the way down to everyone that touches a potential customer in any way. So really, it comes down to like, hey, can you get the right customer traction, validation, and can you make sure that you continue to get the right amount of engagement? I think those are probably the most paramount factors to consider.
That's great. So I guess, how has the overall venture industry changed so far, and what will it look like a year from now from Menlo's perspective?
Yeah, so I mean, depends on how long we end up being in this sort of shelter-in-place remote work capacity. I think initially the shock was majority of folks don't really see an opportunity where they can build a relationship on Zoom from the beginning through the end. I think a lot of the relationships that existed historically are the ones that are going to keep getting funded. So here's the way to look at it from a founder standpoint. If most investors don't really want to go and build new relationships from scratch and drive it all the way through closure on a new investment, because it's hard for them, that human element's still there, that will eventually change. I think that eventually people will get more comfortable with it as they do one deal, they get close to doing a deal, they'll get more comfortable with it. But given the fact that sort of that threshold of feeling comfortable with being able to recommend a deal is sort of relatively high right now, I think that from a founder standpoint, if you think about who is essentially that you have a relationship with, and if you already have a relationship, make sure you continue to double down and build on that relationship. If you can build on that relationship and give them updates, give them regular status, and educate your investors on what is happening in your specific industry, that builds rapport. And so the beauty of it is that since they're not talking to new folks for new investments, the existing relationships end up being the ones that actually kind of bubble up to the top and you get more attention. So even if it was not top of mind for them then, it's not top of mind for them now. But I think the other thing to think about is that the world has changed for everyone, but it's also changed mostly for founders. You probably had to come up with an entirely new plan, an entirely new strategy of the way that you're going to run your business. You may have had to take a headcount reduction. You may have had to do a down round or flat round, and that's totally fine, because you have to do what you have to do to be able to survive this potential environment that we're in. So what it comes down to is that when an investor asks you what is your new plan, feel free to share the realistic plan. You don't need to sugarcoat it and share the long-term vision of hey, we're still going to 2x year over year. People understand this is a new world order that we're in, and there's going to be some potential challenges and stumbling blocks, and it's better to be more realistic than opportunistic in this case.
I mean, the new up is flat, I guess, for investors to think about.
I've heard that so many times.
Yeah, and I think also from our perspective, at the earlier stage where there aren't a lot of metrics to go on when looking at a company, it's a lot harder. It is a lot of gut feel and feeling out the founders. You guys are a bit later in terms of A, B, and later stage rounds. At the early stage, how have you changed the way you look at the founders, TAM size or the metrics that they have so far, if they're just getting to product market fit differently? If not, if it hasn't changed at all, what were they before then?
Yeah, so I think it really is about you painting that picture of how what your previous plan was, what the current new plan looks like. And based on that, what is your serviceable, addressable market that you can go through? And if your SAM is changed now for the better or for the worse, it's really figuring out, okay, well, if the current market is now shrunk and you don't have an opportunity to actually get enough market share because people are going to view you potentially now as not a venture scalable growth engine, venture backable business, Now you got to figure out, okay, what adjacencies exist. What are some sort of adjacent opportunities that you can add to your current serviceable addressable market that you can go after to increase your TAM? And if your TAM is too small, then maybe you're chasing the wrong potential customer. You got to figure out what the right customer is and where the right product market fit occurs. So maybe just kind of summarizing what's the most important thing to think about is that at the very early stage, it's figuring out what is your product, is it meeting the needs of your customers, what are your customers' needs actually is probably first and foremost. And then beyond that, it's can you really get that product market fit where you can get that flywheel going, where you can get customers coming to you and building that foundation. And if you can get those sort of nails hit on the head early enough and quick enough, then you're going to be able to do well.
That's great. Just to double click on the Zoom investment you made, it was a Series B you made, or when was the Zoom investment at Qualcomm?
That was a seed investment at a $15 million pre-money valuation. So it's when you see a great founder with a great vision and being extremely product focused and is not afraid to sort of like take a risk and go against some of the large players in the space. When everyone said there's too much noise in the space, that's when you want to back that founder. And that's kind of when myself and the team worked on that deal. We had a few of us that were champions who pounded the table, and we got really excited about getting it done. The consensus around the room was $15 million pre-money valuation. That's crazy. Why would you invest in this company? There's too much noise. How are they going to compete against the videos of the world and the WebExes of the world? And the truth is they had a great vision. They had built the codec from the ground up. They had a great technology. They had differentiation and built essentially a product that would be easy adoption. One of the challenges early on for the company was that they did have some SMB support. They had some early businesses that were using the product. Startups saw a lot of sort of value in the product, but enterprise was actually a tough sell at the beginning, mainly because enterprise is hard to change. Enterprise usually, they get sticky on a certain product. They feel comfortable with it. They think, hey, it's a Me Too play. Everyone's using it. Me Too, not in a different sense. Where if someone is using it, if your peers, the CIOs that you know are using it, then you should probably use it, right? Maybe not. I think that the approach should be, hey, if it's a new product that makes it a lot more collaborative in the way that you engage and gives you a tool that makes it easier for you to actually have the level of engagement that you want from a collaboration tool, then, and also does things beyond what the current products do, then you should be open-minded and think about it. I think that's sort of the new corporate mindset that I'm hearing from most of the CIOs I'm spending time with, is that if something gives you a 10x, then you should probably at least experiment with it. Otherwise, you're going to fall behind. Some of the CIOs that ended up saying that, hey, WebEx is the only solution that's out there, or I feel a lot more comfortable using Meeting Place or one of the old solutions that existed. Those are the ones that are now saying, oh, I wish I'd switched to Zoom earlier in this time that we're in these days. Where here's actually another data point that sold it for me in the early days of Zoom was that when you see that one-to-one video communication works across the board, whether it's Skype or Hangouts or Zoom or WebEx or whatever else may be, but it's the many-to-many communication where most technologies fall short. When you've got a technology differentiation that helps you allow many-to-many communication in low bandwidth environments, and we're in a telecommunications company, Qualcomm has enabled communication essentially from the early days of essentially people connecting, mobile phone connections, CDMA technology. And that ended up being sort of our thesis, that there's a product that's allowing many people to communicate one-on-one. Sure, Zoom got great headwinds, great tailwinds, and continue to do well in this market. And they've done amazing. I think we're very proud of where Eric and team have taken the company.
Wow, I can only imagine what that pitch deck said in terms of the size of the TAM they thought it was. And I bet it didn't have virtual weddings or workout classes as adjacent markets in their TAM then, but fantastic.
Not at all. I mean, our guess was, sure, this could be a $200 to $500 million exit.
All right, that's why venture works. So do you have any tips for fundraising during COVID?
Yes, I think we touched on one earlier, which was build relationships with the folks that you already know. Build relationships with new people knowing that they're probably not going to be able to make an investment just building a relationship over Zoom. But if as markets start to open up, there are going to be a lot more people that are going to be wanting to spend time getting to know each other in outdoor spaces. So it's really figuring out who's open, who's got a thesis in your space, figuring out who your target list is, and building a relationship with them early, giving them updates, even if it's an initial no, or if it's an initial, hey, we're not sure if this is going to be a market that we want to potentially invest in, or we're still trying to get to know the space. We're talking a number of players. We like what you're doing. It's that human element and the founder connection that goes a long way. So if you can paint a picture that you are the right person to build the product, you've got the right product for the market that you're going after, and you feel like this is a scalable growth engine that you can put in place, then I think that things would start to fall in place. Be patient, build a relationship, and look for the long game here.
Yeah, I think one thing we try to get all of our founders to do, even if they're not fundraising, is one, send out monthly updates. You know, you have your investor friendly ones and then your non-investor ones, but set aside a time at least once a quarter to have conversations with, you know, future investors, even if it's just giving
Absolutely.
them a 15-minute update call when even you're not raising. And now during COVID, I think that's even more important. That's great. Thank you.
And I think maybe just one layer further, you totally on point with that, is it's not just about asking for money, it's about asking for advice. It's an old saying that we've always heard. So it's asking for help. It's saying, hey, here's the way we're thinking about it. Here's our thesis of the way that this is going to potentially work. What are your thoughts? These people have seen thousands of pitch decks. They've seen thousands of companies that are going through their their process. So they know what history looks like. They know what succeeds. They know what the right indications of success are. So to get feedback from them and take their feedback and implement it and come back and close the loop and say, based on your feedback, here's what we did. And here's where we think that this has helped us, or here's what we think it didn't help us. What are your thoughts now? So getting those data points can help you fine tune your message and your go-to-market as well.
Oh, that's perfect. I mean, there's a lot of patriotic Canadians on the call. So obviously want to know, is Canada a target geography for investment for you at Menlo? And also, I guess I'd add, are there certain areas that you are really focused on now, whether it's Asia, India, LATAM, certain areas now that you're really focused on?
Yeah. So historically, Menlo has been a fund that's been 99.9% focused on North America. And North America does include our neighbors, Canada and US. We've talked to a large number of companies. We actually just sold one of our portfolio companies to a Canadian company. Six River Systems, which was a warehouse automation robot, was acquired by Shopify. So we're proud to be shareholders in Shopify and continue to support their continued growth. So given that, I think we're very excited about some of the opportunities that are coming out of Canada as well. I think we found that we back Canadian founders. We have actually a large number of them in our portfolio. Many of them have decided to move to the US, but there's still a few that we have a relationship with and we're continue building relationships with for the long term. So absolutely is the short answer. Part of it, the challenge right now, as I mentioned, is travel, and people are not getting on a plane, traveling to some of the hot spots where essentially like the East Coast of Canada has some really good quality AI computer vision startups that we've continued to track. We're really excited about. There's been a lot of security that's been coming out of there. So I think there's a lot of opportunity. We're excited about that. And we can't wait to build a relationship, get to know each other. Not saying that we're going to pull the trigger on the next opportunity we meet out of Canada or even the East Coast of the US for that matter. But if we can build a relationship early and get to know each other, makes it easier for us to pull the trigger when timing's right for all of us.
That's great. And just expanding on that, are there any areas outside of the US that you are really excited about at Menlo?
Outside of the US? So we typically do mostly North America.
Okay.
So Canada, US. But we have backed founders that have a thesis and building a product in our specific thesis areas that we're excited about, out of other countries that have decided that, hey, they want to build a product. They do want to have a tier one investor in as part of their fundraise. And also we we got to know them over a period of time eventually. And actually, a lot of those relationships did start over video conferencing, Zoom, or phone calls. But eventually, a lot of folks decided that eventually they can move to the US. They can move to whether it's East Coast or West Coast. And we've backed companies before they moved with the goal that eventually they're going to move. But we've also backed companies that decided, hey, they've got great structure, they've got a great team, lower cost to build the product. The cost of hiring employees is extremely high in the US, so they can create capital efficient businesses. But at times the founders decide that they want to go back and forth, and that's good enough for us as well. So we don't typically do a lot of international, but if it's a company that's in our thesis area that we're excited about, that we have conviction in, and we want to potentially support them, absolutely. And it's I'm excited about that as well.
Fantastic. What areas do you see as the most promising investment areas coming out of this pandemic?
Yeah, so I think the way we look at it is based on buyer behavior. And we spend a lot of time with CIOs, CXOs across large corporates to understand, well, where are they spending money? And the initial shock factor, the biggest problem those CIOs were trying to address, and based on like 40 to 50 CIOs that I've spoken to, is that what's top of mind for them initially was collaboration, communication, and security, and remote access, mainly because their workforce was now working remotely. So that put them sort of in an interesting space. What I'm seeing coming down the pipe next couple quarters is automation. So I think what some of the CIOs talk about that they're interested in is around opportunities where certain workflows are automated, archaic workflows that can be digitized and automated are top of mind for them. For example, in the area of AI ops, service desk, and HR ops, that's been top of mind for a lot of folks. And it's been saying, hey, if I have less number of employees, because we've had layoffs or we've had some challenges around having people be on call center duty or whatever it may be, are there technologies that can automate that? So there are a lot of industries that there are still a lot of manual workflows in place. They have not been digitized yet. We do a large number of SaaS investments. And the main reason we do a lot of SaaS investments, and the reason they've been extremely successful for us, is because these SaaS investments are solving unmet needs in the market in those specific industries that they're working in. So a couple of examples, like Everlaw is a company that we invested in the legal tech space. Historically, legal tech's been sort of a low-laying, not a high-growth space. But what we've seen is that when they've become a system of record, like Everlaw, and they're working across the entire value chain when it comes to document analysis, e-discovery, working with law firms, working with corporates, working with even attorney generals, that puts them in a really powerful position and doing extremely well. So we're excited about companies like that continuing to sort of prosper and grow. Same thing was a company that we had in the insurance space. The insurance business has continued to sort of evolve and grow. And we've invested in a company called Indio. Indio was able to create sort of workflows and automate some of the processes that insurance agents use to process some of the challenges that exist in that market. Sort of one level beyond that, there's been a lot of companies that are around taking home renovation space, like companies like Hover. Hover's done extremely well around taking 6 images of the outside of the house and create a full 3D model of the house using a mix of 2D images from a mobile camera, mobile phone, and geospatial data, and creating a full 3D model that can be used for now material estimations, even around doing measurements and even material replacements of saying like, here are the materials that we could potentially use in that space. But then what's also really exciting about that is that we've noticed that adjusters for insurance companies are now using Hover to be able to do what they were doing previously, which was driving up to a house and doing an outside picture and doing condition reports. Now they can ask the consumer to take 6 images of the house and create a full 3D model of the house. So that makes it, again, that much more exciting that there's opportunities where companies like Hover are serving unmet needs in the market. So that's kind of high level, the way that we're looking at it. So digital transformation's top of mind. I think there's certain industries that are changing. Education, as we know it, will change. I think schools are talking now about, could you potentially go to school for 2 days a week and switch with half the population on 2 days, half the other population the other 2 days, I think it's crazy. I mean, we never thought schooling is going to change that way. I think there's a lot more emphasis around apprenticeships. That's an interesting market that we're looking at, or considering the way it's changing, the way that the future workforce is being created. Telemedicine is going to continue to change. I think current telemedicine solutions end up actually scraping the surface, where you're seeing certain aspects of day-to-day diagnosis or checking for vital signs has been more visual. But going one layer deeper, where you send a kit out and say, hey, could you potentially put these sensors on you, and the sensors can give us additional insights and help us make a better diagnosis. That's again been an interesting potential change that's going to come down the pipe. I think with employees being remote, the workforce is sort of demanding that if you're managing your employees remotely, I think companies like Workday are going to get significant amount of traction. But there are also a lot of great companies that are adjacent or work in the same value chain that are also getting a lot of value. So talking to a lot of hiring managers, they're saying, hey, being able to actually interview employees and be able to actually hire employees remotely is just as hard as the way investors think about getting to know a potential investment opportunity. That was an analogy that was brought up recently. And people are saying, hey, is it possible that maybe there's a tool that help us vet employees in a more efficient manner and be able to see a larger pool of employees than potential candidates than we previously would see. So I think HR tech and employee management is going to continue to evolve and change. So maybe those are some highlights. I don't know if you have any specific questions on areas.
Yeah, no, I think that's all great. I think, everyone's sort of seeing the time frame for the automation workflows being adopted by Main Street businesses go up 3 to 5 years. I mean, we're seeing it in our own portfolio, telemedicine with on-call health, adjacent industries that they never thought they'd service are actually being serviced now, like vet care, dentist markets. In the transportation industry, we're seeing, the Department of Transportation now forcing e-signatures, e-invoices, things like that on construction companies who are okay just, working with paper and fax machines and email before. I think a lot of the enterprise SaaS tools out there, they still thought that they would reach, inflection 3 to 5 years from now, but now they're being forced to be adopted, which is great for companies that we have both invested in. I think the only probably downside is the newer investments we were looking to make are now being accelerated so quickly that may not even need as much funding or any funding at all because of the mass adoption of some of their tools, which is great for those companies. It just misses out on some opportunities. So no, that's awesome. I guess as a Series B and maybe even an A investor, what are some of the key metrics and benchmarks you look for, given a company maybe on the line just raised their Series A?
Yeah, so I think efficiency is one of the top things that we look for. Having revenue and good revenue growth and year-over-year growth, quarter-over-quarter growth is again very important to look at for a Series B company. Having a scalable growth engine, I think that's again top of mind for a lot of the factors that people care about when they're looking at evaluating companies, saying that can you be capital efficient, create a product that can actually scale and grow in an efficient manner. Again, product market fit continues to be very important, but also expansion. So once you've got a foothold in a certain market, can you expand beyond that? And can you increase your overall landscape that you're going after? So we have a fund called the Inflection Fund that actually invests in companies between $5 million and $15 million in ARR, typically writing $20 to $30 million lead checks. And the approach there is that, hey, look at companies that have already figured out the go-to-market. They figured out the growth engine. They figured out how to actually build product and be able to deliver to their customers. And that's where we come in and we help them with sort of that last 1 to 3 miles to help them get the right tools that they need, whether it's building the right management team, helping them with overall channel strategy and go to market, helping them with the tools that they need to be able to help them accelerate their growth. And that we've funded a large number of companies. I mentioned Hover, Benchlink, Fieldwire in the construction space that are sort of in that Series B, C timeframe where they're looking for that additional level of push. That fund that I mentioned is called the Inflection Fund specifically for that reason, where we're looking at these companies that are about to inflect, that have high growth, They're within our revenue metrics. Usually at that kind of revenue, you've got product market fit figured out, and helping them expand beyond that is kind of where we go for that.
So can we take an example? Maybe let's say you're an enterprise SaaS company. You're looking at what kind of LTV to CAC or month over month growth for, forecasts or metrics for them to kind of chew on. If you have any suggestions, is it 3-to-1 LTV to CAC, 10 to 15% month over month growth? Where you see things that are interesting?
I mean, I'd love to see 100 to 150% year over year growth. Okay. So break that out. I mean, that's typically 10 to 15. I think 3-to-1's probably a good position to be in. I mean, I think that's healthy, and obviously we always look for as much as we can. The better we can get, the better we look for. But I think the idea here is that where are they in that state of time as you've gotten to know them over certain periods of milestones that you've gotten to build a relationship with, going back to that build relationships early. And what's that trajectory, and how does a company look like it's going to continue to grow? And what could we do to actually help them accelerate that growth? That's kind of the high level data points that we look for as well.
Perfect. All right, so now let's move into what you really focus on a day-to-day basis, and what you're so good at is business development and partnerships. So can you talk a bit about how Menlo builds value in their portfolio companies through BD and partnerships?
Absolutely. So I think the main thing that we look for is that actually what I was tasked with when I first joined Menlo was, hey, talk to founders, talk to companies that we have within our portfolio, or even ones that we're talking to and building a relationship with, and figure out what is it that they have a specific need for. And the top of my list was everything around customer engagement, partnerships, channel relationships. Obviously, fundraising has been top of mind. You need money to be able to kind of continue to grow. And I think those are sort of the main things that I focus a lot of my time on. But we'll touch on M&A further down, and the way that I think about M&A and the approach that I'm taking to make sure that it becomes extremely efficient and part of your DNA as you're building your company, and how you should view it. But I think just focusing back on the question that you had, which is around BD and partnerships, at times it's about opening certain doors, influencing certain relationships. So there are a lot of potential deals or engagements that are hard to crack. It's hard to get an actual engagement or relationship with a potential senior level person within a corporate that's going to become your customer. But if you've got the right underlying engagement with the right potential individuals within the organization that are your buyer persona, leveraging your investors or your other relationships to be able to get senior level air cover would be actually the best way to engage. We do a lot of that. We actually have an advisory group of CIOs that we spend a lot of time with. But these CIOs are also very influential individuals in the market, where they can help us figure out, hey, are we chasing down the wrong path? Do we have the right approach? Is this going to resonate with your peers as the company's thinking about their go-to-market? And so we help with that senior level leadership and guidance, but also influence. Peer influence has been paramount in making sure that companies win significantly larger number of deals than they otherwise would. The second part of it is, I mentioned partnerships, co-selling opportunities. So a lot of corporates, they might be looking at either expanding or building a product or buying something in your area. We'll touch on buying later, but the partnership side is that there's an opportunity if you can actually help a company or a corporate do their job better by your product being synergistic with their product or their offering, then you can actually together win more. That's where companies come in. They say, hey, could we potentially try this sales motion together? Could we, we've got a large set of customers that are going after the specific same sort of needs and problems, and seems like our products are coexisting in this environment. So do we couple up our efforts and potentially co-sell? What that works out very well is that these corporates have that reach, whether it's from marketing or from a overall strategy or from a promotion standpoint. So I spend a lot of time with cloud providers, Amazon, Google, Azure, even internationally, where these cloud providers can actually help a company be able to get access to a marketplace, could get access to their potential marketing channels. They can get access to opportunity where the field work or the field force, the sales force that they have that are selling their product can potentially help you sell your product as well. That might include either some kind of a fee or rev share or whatever else that the model ends up being. We'll work through that obviously when it comes up. But it really comes down to, hey, if there's a synergy, if you can unlock that synergy, if you can help each other succeed and you specialize in your area, that deeper relationship can help accelerate your channel and your growth as well. Now talking about channels. So I think there's a lot of, once you figured out your product market fit and you're scaling and growing, we spend a lot of time with the large distributors, the Synexes, Ingram Micros, Tech Datas of the world, CDWs, and various channels that can actually help you get that further reach that you potentially would need to be able to succeed. So having someone that has a willing and able pool of buyers goes a long way. The next layer that we spend a lot of time with is around management consultants. So the McKinseys, the various firms that are out there, the Bains of the world that we're excited about that we have deep relationships with, they have a number of corporates that they work very closely with. And those corporates are usually ready to make decisions once they engage a management consulting firm. And typically a management consulting firm helps them go through some kind of a journey of figuring out who are the companies to talk to. So making sure that you're on the radar of those management consulting firms, they know about you, whether it's through your investors or directly. When opportunities come up, you will get that call, and that's going to help unlock a lot of opportunities for you to be able to sell. So and sell to their clients, and they'll help you navigate that world as behind the scenes. Because typically, when a corporate brings on a McKinsey or a Bain or another firm or BCG, they typically are ready to make decisions. And we've seen that the sales cycles are much shorter when that engagement happens. And that's why we end up actually building very deep relationships with these folks. And that's kind of a high level on the BD and partnership side of the various channels that you can tap into to succeed.
And just to be clear on the CIO, you mean Chief Information Officer, not Chief Investment Officer. Perfect.
Yep.
Just
Chief
so people understand.
Officer.
Okay, so how should I, as a startup, evaluate corporate partnerships, and what's some of the key questions I should be asking?
Yeah, so I think really figuring out that, is this a conflict situation or is there a potential synergy that exists early? So it's asking questions about what's keeping you up at night. What are your challenges? What are the problem statements that you're working through? And based on those problem statements in your specific area, are you able to meet their needs, or could you potentially down the line meet their needs? So if you've got the data points of what their needs are, what they're looking for, and specifically, I think you're probably referring to corp dev. In corp dev, they know the most intimate things about their companies. They're not always looking out for M&A, and we'll touch on M&A later. I think the main thing is that they're always looking at, do you buy, do you build, or do you partner? And corp dev is an important avenue where you can actually build deep relationships where they might help you with the conversation of potentially partnerships and help you navigate the larger organization. Sometimes the decision maker in the product, in the business unit or the product side is harder to reach, and they're not as engaged when it comes to external outreach. But corp dev is looking for figuring out what they can scout that might be able to fit that puzzle piece that's missing. So we've had companies like Scout RFP, which was a next-gen procurement platform that was part of our one of our investments. And that company built a very early relationship with Workday. Workday ended up becoming an investor. They ended up becoming partner/customer. And eventually that led to sort of that aha moment where Workday said, hey, we think Scout is that missing puzzle piece. And they ended up buying the company a little over 6 months ago. And again, it's been that deep relationship building early, getting to know each other, which can lead to customer engagement or partnership or an investment, which can accelerate your path to saying, hey, eventually this might be that missing puzzle piece. And together we could do more than you would be able to do it separately or loosely coupled.
Awesome. Thank you very much. So I guess which team should handle partnerships early on at the early stages, management or sales?
I think at the early stage, partnerships should be driven by the CEO or the COO, or at least if there's a COO, or at least someone that can get that pulse on the market to drive that ship in the right direction. Because a lot of these conversations are deep conversations, and the corp dev folks end up having certain things that they want to understand. So showing senior level leadership on your side and engagement on your side, on the startup side, can actually help you with with making sure that you're giving them the level of respect that they're looking for, and also giving them a viewpoint of the macro. Sometimes sales might have a great viewpoint of what the customer needs are, and I think that's a good pulse on the market, on the specific needs of that area that they're focused on. But I think having that macro viewpoint of where the overall ship is going is what most corporate development folks look for. So management teams, CEOs, usually where my recommendation is on those conversations.
Yeah, absolutely. I think in our few examples you've had recently, they never just stay as a partnership conversation. They often get split up amongst a bunch of different teams. And I think if you're going to do a commercial agreement, you can get that done with management, and then you're going to be handed off to corp dev, and corp dev is going to have some conversations with you about maybe investment. So having sales try to jump in and out is not really a good starting point, I think. But maybe handling success or onboarding afterwards is good.
I think sales can create sorry, just one more data point there. So sales can give a viewpoint down the line. So at some point in time, corp dev might want to engage with your sales team to get to know how their go-to-market motion looks like, obviously under NDA. But I think that data point is only a part of the overall puzzle piece. The main component of it is really the CEO knowing, based on where the ship's going, if this is even a relationship to go down, if it's a relationship that you want to even potentially explore. And it's all, there might be the conversations you mentioned might shift over to M&A at some point. And the main thing is that it's okay to have interest. It's actually, it's a good thing to have interest, but it's also okay to say no. I can't count how many times we've said no to corp dev inbound conversations that went towards, hey, we'd rather just buy a company. But my approach always is, hey, when you get an inbound, sure, it's humbling, it's great, but let's say, hey, why don't we get to know each other? Why don't we build a relationship? Let's start dating. Let's figure out if we want to potentially crawl before we walk, before we run. At this point, what could we do together that can help address the needs of both of our customers? And getting that channel relationship in place or that partnership in place can help increase your value significantly down the line. So I think it's okay to say no, and don't just focus 100% on they're only here for M&A and that's all it is. I'd rather shift the conversation early on to, hey, what does a partnership look like? How do we work together? How do we align our objectives to make sure that we're working towards the end goal of doing more for our customers together?
That's a really important point, being comfortable saying no and trying to, walk before you run. So I guess that kind of leads into the next sort of stigma a lot of early stage startups face is, how can I partner with you if I don't know if you'll be around in a year?
Yeah, so I mean, that's also a topic that's come up quite a bit in these times. I think your investors can create the best amount of validation. So showing support early on, you might have, 12 months, 6 months, 12 months, 18 months runway in the bank, which is great. No one's saying go print your bank statements and send it to them. But what I'm saying is that have someone vouch for you, and who better vouch for you than your actual investors that believe in your vision, your product. And if they can actually send a note. I mean, I can't count how many times I've sent a note to potential buyers or procurement folks, giving them an overall picture of our thesis, our thoughts, the space, why we're excited, why the founder is the right person to do it. Really just the same thinking that we've had when we made the investment, the same thinking that I actually portray when I talk to procurement folks or CIOs, chief information officers, or CISOs that are looking at buying a product. And it's really about saying, hey, here's why we're excited. Here's why we're in it for the long haul. Here's why we think this is the right team and the right product. And here's why we think that you should potentially become a customer. And here's how they can solve your challenges and your specific problems you're looking for. Painting that picture goes a long way. Gives them that warm and fuzzy. They can go back to their, whether it's their board or their management, and say, hey, we did our homework. We talked to these investors. These investors are on board, they're excited, and here's some other customers that they have that can vouch for them as well. So having a referenceable list of customers is really important as well, saying that, hey, if you've got these top tier customers that have already vouched for your company and are working with you, then I think it creates, again, that validation of that Me Too play, where if their peers at other large corporates are using the product, why are you not using it as well?
Yeah, I totally agree. Not to pat ourselves on the back as investors, but I think, having somebody who's got a lot of skin in the game, who has bet on you a lot, getting them in the room with the buyer or the potential partner from the corporate side, you often speak the same language as them, and you kind of see things from their point of view, and they kind of relate to you differently than maybe as a startup founder. So founders should not be holding back on introducing their investors for worry that they're going to say something that could blow the deal up. I don't think I've ever seen a deal get blown up because of an investor being asked to support their founder during a partnership conversation. So that's really good advice.
And I think the other data point that a lot, and to your point, 100% agree with you. And the other data point that a lot of these potential buyers look for, by buyers I mean procurement or the CIOs of the world, is that an overall viewpoint of the landscape and why this is a better product than the competitors that they're looking at. And if we can paint that picture as investors for them and tell them, hey, we scoured the space. We looked at all the companies and we picked this company as a horse we wanted to bet on. And the reason we bet on this company is because of X, Y, and Z. That ends up actually giving them that additional validation point that, hey, if a top tier firm, if a high quality firm is investing in this company, there's a reason why they back them versus the competition.
Right. You've almost done all the research for them on analyzing the competitors that they need to go and then present to their IC or something, which is really helpful as well. So that's good. So let's hop into what people really are excited to talk to you about is mergers and acquisitions. So you obviously worked on a lot of them. I don't know how many deals you've done in your career, but you've done some amazing ones. And most recently you said the Six River system, which was I think 450 million to Shopify, or at least that's what the headline reported. So when should I start building relationships with corporate development teams, even if I'm not actively looking to get acquired?
I think as early as possible, but making sure that you build that relationship on a human level. So it's not about, hey, do you want to buy us? It's about, hey, let's get to know each other. I want to get your viewpoint. I value your opinion. I want to build a relationship to get to know where we can potentially collaborate down the line when it comes to our joint customers. And really starting and focusing in early on that, on the overall specific partnership or engagement side. So as I mentioned, corp dev knows the most intimate things about their overall company, both at a macro and also micro level, and having an intimate understanding of that sort of buyer behavior and buyer activities and sort of that where they build or where they partner side of the house is really important. So I think it really comes down to, I guess, if I summarize what I just said in one sort of two words, it's information flow. If you can get information flow, you got that path or connection, it goes a long way. But the second thing is planting seeds early. So imagine you got an inbound from a corporate that said, hey, we're paying X amount, ridiculous multiple, your investor is going to be supportive. We want to buy you guys and want to close in 10 days. It's happened to me. It's actually happened with a company I was on the board of. And the main thing is that had we not built these relationships with various corporates that were in scope with us and had partnerships in place early on, we probably couldn't have gone out there and created a competitive bidding situation. So it really comes down to if you can build enough relationships in your landscape to make sure you're getting the right information flow that can help you build a better product, but also building partnerships across the board, trying not to do exclusive partnerships. I'd rather have the scale be skewed to your side, to your benefit. Having those built early gives you sort of options. And I think should one engagement or potential future down the line M&A not succeed, or potentially get an inbound that you want to explore alternatives on, then you have options to choose from, because those milestones, those seeds you planted over time is what people look at of, hey, here's where the company was when I met them 2 years ago, a year ago, 6 months ago, and here's where they are today. And here's where we think they could be when we unlock those synergies. That's what corp dev usually looks for, is that when we buy this company, after we do integration, what synergies could we unlock to unlock certain value in the company that didn't exist before. And that's kind of high level. If you've got those relationships early, you've got options of who else you want to potentially bring in before you get exclusive with someone. That's kind of, I think, the basis of it is the milestones. There's a saying that good companies are bought, not sold. So if you're out there trying to sell your company, it's going to be a much challenging road than if you are out there just minding your own business, building a great product, continuing to grow, building partnerships, and eventually the right buyer will come along and make the offer you can't say no to.
Yeah, I think it also goes back to sort of the earlier comments around trying to find your next round of investors. Every quarter you set up sort of update calls. And that's information flow on what, next round investors are looking at. Include corporate development in that update as well. Set aside time to reach out to them to get that information flow. So maybe what would you say to a founder if they're like, hey, I'm trying to figure out who a good corporate development person to even contact looks like? What do I send? A LinkedIn message? Do I find their email and say, hey, I'm the CEO of this company, would love to build a relationship and share some information flow, what we're building with our IP and what you guys are working on there? Is that a starting point?
As you'd imagine, most corporate development folks, similar to many investors, get a lot of inbound all the time. Right. So it's really being able to cut through the noise. So last resort, yeah, you could write a very thoughtful email, a thoughtful, potentially thoughtful LinkedIn message, and making sure that you can be creative enough that it gets their attention. But I think the best introductions are made through people, mutual connections that you have. So if it's someone that you have trust with that can make that introduction, that goes a longer way, and you end up actually getting a deeper level of engagement. So leverage your investors, leverage your network, leverage other corporate development individuals that you know, because most corporate dev folks actually know each other as well in the similar industries. A lot of people move around from firm to firm, and you have deeper relationships across various firms. And you can actually leverage the people that you know to get to the right person, which will result in the highest level of engagement from the folks that you want to connect with. And once you've connected with them, go back and close the loop with the person that made the introduction of say, thanks for the introduction. Here's what I learned. Here's what if it's relevant, obviously, here's what the engagement looks like. Here's where we can potentially help them. And thank you for being thoughtful and making that connection for us. So I think it's
great advice.
It really comes down to who can make the connection for you.
That's great advice, and obviously why you have a role at Menlo to do those things. So how should startups think about M&A versus strategic investments at the early stage?
So it's a double-edged sword. I mean, to be completely frank, I'm a little biased because I actually spent 7 years in a corporate VC, and I think that corporate VCs can be helpful in a variety of ways. I think corporate VCs can open a lot of doors and give you access to technology and help you with certain things from a supply chain standpoint that you might not have access to, giving you product thought leadership, which sometimes you can't get unless you're with a corporate VC or a strategic. But it really comes down to, I think, that there's also a caveat that if you are building a product, are you building for the larger community, larger masses, or are you building for a specific customer? It's good early on to figure out a customer viewpoint and figure out if you can build a product based on the feedback of a certain customer. So that means that, hey, if they got vested interest, they got skin in the game, means that they might want to make a strategic investment. But I think we talked about M&A already, of just planting seeds early, building relationships. People wouldn't say no early until you're ready and down the line at the right size and scale that you might want to consider. You could do more together than you'd be able to do it at it alone. And even if a corp dev person says, if we're not buying you, we're going to go buy your competition, it's fine. It's okay to say no still. I think it's, you let them go through that exercise on their own. Eventually, if you're the better product, you end up succeeding. The truth is most M&As, they fail because of one reason, it's integration. Large corporate bureaucracy, politics, and integration. These founders are used to succeeding in a capacity where they can actually be more agile and work more efficiently. And sometimes when a company is acquired, you end up dealing with a lot more bureaucracy, red tape, funding issues, budget issues. And as a result, you might not be able to scale the same way you were before. That being said, if a company ends up buying your competitor, one, it's good validation. Two, it gives you the peace of mind that, hey, you might be more agile and more efficient and be able to beat them. There's a whole concept of death by 1,000 cuts. I think that still holds true and is valid today. So I think if someone says they're going to buy your competition, if you're not going to sell to them, don't let them bully you. It's fine. Just keep driving forward. Keep driving your ship forward and doing what you got to do. But if a corporate is excited about what you're doing and they can help you accelerate your needs by getting skin in the game, and they want to make an investment early and make a strategic investment, as long as they're not going to significantly hinder your ability to address the public needs or the full market, you're not going to be going down a rabbit hole or niche, I think that's great. If they can give you the right tools that you need to be able to scale more quickly, having skin in the game can only accelerate that.
Yeah, it's better to get them on the same side of the table as you than across the table from you. at the final negotiation. I guess lastly, how many deals that you are a strategic investor in at Qualcomm did you end up acquiring the company outright later on?
So corporate VCs have different approaches. I think some corporate VCs end up investing to acquire. It's sort of their chance of getting an inside viewpoint, optionality. They may even ask for certain terms like ROFRs and right of first notification, which I'm not a huge fan of. I think they're not entrepreneur friendly. I think it's actually not market friendly, and those investors don't really get a ton of deal flow, mainly because the having a ROFR on a deal ends up actually leaving a bad taste in most of the tier one investors' mouths, that they don't want to let someone in that is going to ask for a ROFR or side letters or right of first notification or whatever it may be. So that ends up actually being sort of against the methodology of why corporate VCs should exist. If you're investing to acquire, then you're probably not going to see the cream of the crop of companies, mainly because the cream of the crop companies don't want to have sort of overburdened terms on a deal that they do. They'd rather have it be as clean and as efficient as possible. That being said, so at Qualcomm, when I was there, we only acquired 3 companies at over a 10-year period out of the entire portfolio. And those 3 investments that were acquired were all driven by business unit. There's a church and state between corporate development and corporate VC in most larger companies, where corporate development's activities are decoupled from corporate VC's activities. And you make an investment or you buy a company. But if you invest to acquire, you end up actually giving the wrong signal to the market.
Fantastic. Wow. Well, I really appreciate you taking the time today, Houman. It's been a great insight into how top tier VC thinks. Maybe we'll just keep it open for 1 minute to see if there are additional questions, if you want to plop them in the chat. If not, we can wrap it up here. And this recording will be made available online afterwards. Thank you so much, Houman. If people want to get in touch with you, where should they reach out? On LinkedIn, over email? What's the best way to get in touch?
Email works. LinkedIn's great. I'm always very open and always available. My email is h@menlovc.com. Super easy to remember since my name's not very easy to spell. So please feel free to reach out if I can be helpful. In addition to that, please connect with me on LinkedIn. Happy to have you in my network, and any friend of your firm is also a friend of mine. So
thanks so much. I really appreciate it. Everyone, thanks so much for joining, and everyone stay safe and take care. Bye-bye.
Perfect. Thanks for having me.